Hey everyone, my name is Daniel and welcome back to the Finance Channel. I hope all you're having a great day out there. As always, the stock market is currently in the midst of a massive rotation that has been consistent over the past 6-7 months since the beginning of 2021 and continues to happen day in and day out. So in this video, I want to take you all through exactly what's going on in the stock market, what this rotation looks like and what might happen here moving forward, and also how this plays to a potential stock market correction or crash that a lot of people are talking about, and talking specifically about the potential for it to happen potentially in the back half of 2021, if not 2022. So if you end up enjoying this video and potentially end up finding some value in it, please consider subscribing. Now, out of the way, let's get into the video here. So let me show you exactly what I mean here. When we look at the stock market as a whole, let's just use the S&P 500 as an example here. And again, this is very prominent in a majority of the indexes. Since March of 2020, we have seen a massive run in all the indexes, barely taking a breather. We had a slight one there at the end of 2020, October, November. But again, since then, we haven't had a major correction. We have seen up, and away for all the major indexes. But despite this, within kind of the broad sense of these indexes, again, the S&P 500 tracking the largest 500 companies, Dow Jones, again, tracking those largest companies, NASDAQ tracking those largest companies, we have seen many rotations forming beneath the broader indexes. And one of the kind of rotations that we've seen that has been very prominent for a lot of the people that watch this channel or watch investing YouTube videos is smaller cap companies. Companies trading in the multi-billion-dollar range when it comes to their market cap. Let me just show you a few examples here. Despite this massive movement upwards in all the broader indexes, we have seen stocks like the Tattooed Chef down significantly over the past 6 months. SoFi, a fintech company that has been extremely popular ever since their SPAC, down over the past 6 months. Fubo TV, again, a company that has been, ridiculously talked about on Reddit, YouTube, Wall Street Bets, down significantly over the past 6 months. You look at the cannabis industry, again, since January, all the cannabis stocks are down in a massive, massive way. And this even kind of falls into the cryptocurrency related stocks like Voyager Digital, again, down significantly over the past 6 months. So all of these stocks have one thing in common, and that is that they're trading in the market cap range of anywhere from just a couple $1 billion to potentially upwards of 10 to maybe 15 billion when you look at SoFi here. But either way, you look at a lot of the large cap companies out there, they've had a phenomenal 6 months. Let me just use Facebook as an example here, a very one that has experienced a lot of uptrend here over the past 6 months since, again, March of 2020. You look at a stock like potentially Apple, Amazon, they're not as prominent with this, but again, you see with Apple here over the past 6 months, up substantially. You look at Amazon, up substantially. So again, Amazon actually is a little bit more flat, but the main point still exists, that what we have seen is, despite this massive movement upward in the broader indexes, and because of that, a broader move upward in a lot of these larger cap, larger names like Google, Apple, Facebook, a lot of the larger cap companies have managed to actually experience a downtrend within that. Now, despite this, it can be actually kind of interesting to take a look at the broader valuation of the markets by kind of factoring in and putting all of these different stocks into categories. Let me put this into perspective here. When you look at valuations of S&P 500, 400, and 600 companies, again, this factors in companies into large caps, mid caps, and small caps. What you'll see here is that over roughly the past year, when you look at the large cap companies, again, the companies we just looked at, the Apples, the Googles, the Facebooks, the Microsofts, the valuations of those companies have really been stagnant since late 2020. But when you start to go down and look at the mid cap to small cap companies, you'll see that the valuations of these companies have gone down significantly over the past 6 to 12 months. Also, when you look at small cap companies, down even more. So when you look at the markets as a whole on a valuation basis, because again, when you look at the potential for a stock market crash, one of the most important things to look at is valuations. Where are valuations at? Are stocks overvalued or are stocks undervalued? Well, currently in the market that we are within right now, we've experienced a significant elongated correction in a lot of these small to mid cap companies, while the large cap companies have continued to move higher. So you have a market that is driven purely by the increase in price of the largest companies out there, while within that you have a downtrend in the small cap companies. So when you look at valuations right now, and when you look at the potential for a crash in the back half of 2021 to 2022, you really do have a situation where the stocks that have the most to lose are the biggest companies out there. This is something that I preach on this channel a lot. One of the most important things to do is have, a few things, but one, conviction, right? Understand your company, understand what they do, how they make money, and the future that they have, but also buy companies at good valuations. You can buy the greatest company in the world, growing revenues and profits significantly, minimal risk of bankruptcy, but if you're buying the company at the wrong valuation, you may not make money on a 5-year basis, and that's something that we want to avoid. When you look at the stock market as a whole, you want to buy companies that are great, that you have conviction in, at cheap valuations. And right now, when you look at stocks as a whole, one of the best kind of categories to invest in is small to mid cap companies, ones that have continued growing over the past 6-12 months, but those companies at the same time have had their valuations drop substantially for no real reason at all. Again, there has been talk of, again, that flight to safety where investors are moving to the large cap companies, again, like the Apples, Amazons, Googles, because they're obviously bigger, safer, have a larger track record. But, you look behind that, you got a little bit more risk with these small to mid cap companies. You got them at cheaper valuations. So even if we do see some form of crash or correction in the back half of 2021 to 2022, it really may be a situation where the market gets dragged down by these large cap companies, while in reality, the small to mid cap companies may not experience as much downside as some of those larger ones. I mean, when you look at the small cap index here, when you look at again, this is the forward price, I should have kind of mentioned that here. This is the forward PE ratio of these different companies. So it's factoring in analyst estimates for earnings when it comes to the next 12 months of these companies' existence. So again, this is kind of factoring in all revenues, all profits up to August of 2022. We got large cap companies trading at all-time highs. This is, ridiculously all-time highs from this perspective, despite arguably having the least amount of growth. You have a lot of these larger companies, again, already experienced the beginning of that S curve, the exponential growth curve, while a lot of these mid-cap to small-cap companies have yet to experience that substantial exponential growth. So you can make a great argument here that small caps and mid-caps should be trading at richer valuations than the large caps, which when you look at history here, that's been true. Small caps and mid cap companies have been trading at significantly higher valuations than large caps because of that more inherent growth. Investors, they price into the future, and when you have more growth, you get a higher valuation here. What we see now is the large cap companies trading at the highest valuation at a forward PE on average of roughly 21, while when you look at mid caps and small caps, mid caps trading right in line with what we've seen over the past 15 years here at a PE or forward PE of roughly 17, while small caps trading even more cheap at a valuation of closer to a 16 forward PE, significantly cheaper than what we've seen here over the past 2 decades, which is just great to see from that standpoint. So when I look at the stock market right now, and when I look at what I'm potentially going to be doing within the market that we're currently within, I think we got to watch out for the larger companies, the ones that are trading at larger multiples. And when you look at something like an Apple, although it is a great company, you got to look at the business. How much growth does it have relative to its valuation? In my opinion, Apple is trading rich for where their business is at this moment in time. And you may want to take a look at some of these small to mid-cap companies, whether that be the Tattooed Chef or Smile Direct Club or some of the cannabis companies, which have been beaten down significantly over the past little while here. So, that's my opinion on what's happened here when it comes to a potential crash into the back half of the year 2022. It really will depend, at least in my opinion, on the economic recovery that we have been seeing, which has been a little bit underwhelming. It is coming out that, hey, this economic recovery that we've seen has been propped up, at least to a certain extent, by the different stimulus packages. And now that that's running out within the next couple of weeks here, federal unemployment will run dry. There is a little bit of talk of a potential, at least a substantial slowdown in economic recovery when it comes to unemployment, GDP numbers, etc. We'll see what ends up happening from that front, but my thought remains clear. Large cap companies, I'm staying away from those at least right now until the valuations get better. I'm a little bit more intrigued with these smaller to mid cap companies. Anyways, thank you all so much for watching this video. If you found some value in it, please consider subscribing, and I'll see you in the next one. Bye-bye.